1. The Weekend Gap Nightmare. Real Market Scenario. Welcome to the debate. Imagine you're watching your trading screen. It's a Friday afternoon. Gold is, trading calmly at 1,850 an ounce. A nice, relaxing Friday. Exactly. You've got your position set. Your risk is perfectly calculated and you just log off for the weekend. You're feeling completely in control. But then, Sunday night arrives. The market opens. You blink and gold is suddenly trading at 1,880. Your stomach just completely drops. Oh, it falls out of your body because your stop loss was skipped entirely. Your account is just bleeding out. And the wildest part about this, there are 0 transactions between 1,850 and 1,880. It's just a terrifying blank space on the chart. Right. And that blank space, that's where logic goes to die. 2. What is a gap? Where logic disappears. I mean, it's the exact moment the market stops being this sterile environment of numbers and just instantly becomes an arena of sheer panic. Which brings us to today's focus. We are exploring the ultimate market vertigo, the price gap. Specifically, we're debating how to achieve psychological control and overcome the fear of loss when trading these highly volatile markets. Yeah, and we're looking at this through the lens of institutional frameworks, behavioral psychology, and smart money concepts to really figure out how to survive these violent moves. 3. Keith Watt versus Tom Lee. Right, and I'm arguing that overcoming this fear of loss is fundamentally achieved through technical mastery. I mean, when you actually understand the mechanics, when you view gaps purely as structural footprints left by smart money, the market stops being a threat. It transforms into a very readable blueprint. And I completely disagree. I argue that your technical blueprint is frankly practically useless without behavioral mastery. Gaps are raw manifestations of crowd psychology. It's panic. It's greed. True psychological control comes from strict risk management and mastering your own flaws, not just, drawing institutional lines on the screen. 4. Root cause of fear. Technical ignorance. Well, to begin, I just want to clarify why technical ignorance is the actual root of all that fear. Like, for a beginner, when they don't understand market structure, a sudden price jump feels like pure chaos. It feels personal, right? Oh, they feel like the market is actively hunting them down. Exactly. But when you learn the mechanics of gaps, volumes, smart money concepts, that fear literally evaporates. You see that these gaps aren't random glitches. They're the engineered footprints of massive institutional players. 5. Emotion versus data. I mean, I get the intellectual appeal of that. It's very comforting to think we can just rationalize the chaos away. But let me counter that. Gaps are pure, unfiltered emotion painted on a chart. But they're driven by data, are they? You can memorize every technical pattern, every smart money concept, but when a massive gap triggers your innate loss aversion, or when a soaring price triggers FOMO, the fear of missing out, your logical brain literally shuts down. Cortisol floods your system, right? Adrenaline just takes over. Sure, biology plays a part, but a huge part. True control doesn't come from spotting a structural footprint. It comes from accepting losses before they happen. It's about position sizing and mastering your biological reaction to extreme uncertainty. 6. What is a gap? Technical mechanics explained. I hear you. But that biological reaction, it's only triggered because the trader literally doesn't know what they are looking at. Let's just dig into the actual mechanics of what a gap is for a second. Because demystifying it for beginners immediately strips away that emotional power. Okay, lay it out for me. So, let's compare normal price movement to a gap. Normal price action is just a balanced auction. You look at a standard candlestick chart and you see all these overlapping wicks. That overlap shows a fair, continuous exchange between buyers and sellers, right? Yeah. The market is efficiently delivering price at every single penny. Exactly. But a gap is an inefficiency. It's a visible blank space on the chart where absolutely zero trading occurred. Think of normal price action as a local train. It stops at every single station to let passengers on and off. Right. A gap is an express train that suddenly skips 3 stations because of a massive influx of institutional orders. If you were, waiting at one of those skip stations with a limit order, you just don't get to board the train. 7. Gap equals emotion plus liquidity shock. I come at it from a completely different way. You describe it as an express train, which implies this really neat, scheduled, mechanical process. Because it is mechanical, but it's not. While massive institutions might be the ones pushing the heavy buttons, the underlying engine of a gap is a sudden, violent shift in human fear and uncertainty. It's a biological reaction that we just quantify in dollars. 8. Weekend gap, Forex structure, reality. But the mechanics literally dictate the reaction. Take the Forex market, for example, specifically trading gold, XAUUSD. The Forex market closes for retail traders over the weekend. Your broker just turns off your access on Friday at 5 p.m. Your screen completely freezes. Your screen freezes, but the world doesn't freeze. Over the weekend, some major geopolitical event happens, so central banks and massive financial institutions are instantly repricing the value of gold based on this new reality. And they do this through private off-exchange transactions. Right. The dark pools and interbank markets. Exactly. So when Monday morning arrives and the retail market opens, we see a massive weekend gap in gold. It basically teleports to the new price. That is a structural reality of market hours, not a psychological panic. 9. Crypto example, proof of emotion and liquidity. Okay, but let's look outside of Forex to prove that this is fundamentally about emotion and liquidity. Let's look at the cryptocurrency market. Bitcoin, Ethereum, these are 24/7 borderless markets. Sure, there's no Friday bell. Exactly. There is no weekend closure. You have access to the screen every second of the day. Yet massive, violent price gaps still happen in crypto all the time. Why? Because of sheer, sudden panic. Well, it's a lack of liquidity, right? And a rumor hits social media that a major crypto exchange is insolvent. Within milliseconds, the order book simply empties out. The buyers pull their bids. So when a whale tries to sell a massive block of Bitcoin, there is literally no one willing to buy it at the current price or 5% below that. The price just falls through thin air until it hits a bid. Yes, that is a gap. And it proves gaps aren't just structural scheduling quirks from weekend closures. They are universal expressions of sudden supply and demand shocks, and they are driven by human terror. 10. The biggest myth, all gaps must be filled. Okay, yes, the order book empties out, but the reaction of the retail trader to that thin air is where the psychological error actually happens. And I firmly believe that error is rooted in a technical misunderstanding. What kind of misunderstanding? There is a fatal myth out there. Ask any beginner, and 90% of them believe this. And it causes massive financial ruin. They believe the myth that all gaps must eventually be filled. Oh, absolutely. They treat it like a law of physics, like what goes up must come down and fill the empty space. It's an incredibly bad habit. 11. 4. Types of gaps. Journey through trend. And isn't that psychological trap just a lack of technical categorization? If beginners understood the 4 distinct types of gaps, they wouldn't fall for this. Let's look at it as a journey through a trend. First, you have the common gap, the noise. Right. It's meaningless noise inside a tight, sideways trading range, usually on very low volume. And common gaps do almost always fill. Price just wanders back over them within a few hours. And that is exactly what gives beginners that false sense of security. They think, oh, see, the market always goes back to fill the blank space. Precisely, they get conditioned. But then comes the breakaway gap. This happens at the very start of a massive new trend. It jumps entirely over a major line of resistance. It signifies real institutional conviction. The market is leaving that old price level behind, and it rarely fills anytime soon. 12. Runaway gap trap. Beginner mistake. And I would argue that is where the psychological pain truly begins. The trader who was holding a short position suddenly finds himself completely underwater. The price just leaped over their defense. They're in shock, which leads perfectly into the third type, the runaway gap. This occurs right in the middle of a strong established trend. It acts as a momentum accelerator. It proves the trend is healthy and moving violently in one direction. So, how does the beginner mess that up? Let's look at a practical example in gold. Let's say XAUUSD is in a massive uptrend and prints a huge runaway gap upwards. A beginner looks at that, remembers the common gap, assumes all gaps must fill, and aggressively shorts gold right in the middle of a screaming uptrend, expecting it to drop back down to fill the blank space. Exactly. And they get completely trapped and blown out because they misread the technical momentum. 13. Loss aversion. Why traders hold losing trades. I'm sorry, but I just don't buy that. It is purely a technical misread. Let me tell you why. You're assuming the beginner shorts that runaway gap purely out of a misapplied technical rule. But the real reason they take that trade, and crucially the reason they hold on to that losing trade as gold keeps soaring against them, is rooted deeply in loss aversion. Loss aversion, meaning the psychological principle that the pain of losing money feels twice as severe as the pleasure of making money. Exactly. Taking a loss forces a trader to admit they were wrong. It's a severe blow to the ego, right? And a blow to the wallet. So when they short that gold gap and the market instantly moves against them, taking the loss just hurts too much. So they freeze. 14. Exhaustion gap equals liquidity trap, FOMO, and herd behavior. I see why you think that, but let me give you a different perspective. If they had the technical conviction that it was a runaway gap, they wouldn't have entered the short in the first place. The technical understanding prevents the psychological trauma from ever occurring. I don't know about that. Let's look at your fourth category to see how human emotion overrides everything, the exhaustion gap. You define it technically as the final gasp of a trend, but let's talk about why it's the final gasp. I call this the liquidity trap because of the retail buyers. Exactly. It's pure herd behavior and FOMO. The crowd has been watching gold soar for weeks. They feel this agonizing pain of missing out. The media is talking about it. Their friends are making money. So what do? They panic buy at the absolute top of the market. 15. Smart money versus retail. Liquidity game. Right. That sudden, desperate rush of retail buying creates the exhaustion gap. And what are they actually doing? They're unknowingly providing the exact exit liquidity that the smart money needs to offload their massive positions. If an institution wants to sell 10,000 lots of gold, they need 10,000 buyers, and they'd get them by letting FOMO do the work. Yes, the retail trader's emotion is literally the fuel for the institution's technical exit. 16. Smart Money Concept, SMC Framework, which is exactly why smart money concepts exist. That dynamic you just described is precisely why the technical trader doesn't get trapped. The practical lesson here is the contrast between the smart money approach and the retail crowd. Okay, but how does SMC actually fix the fear? Because Smart money doesn't chase gaps. They don't feel FOMO. They engineer the market to capitalize on the exact herd behavior you just outlined. And for an individual trader, adopting the SMC framework replaces fear with extreme, calculated patience. 17. Liquidity sweep plus FVG, real mechanism. Exactly. Let's translate the SMC framework into really simple terms. Let's look at the Asian trading session in gold. Retail traders love to establish sideways ranges during the quiet Asian hours. They place their stop losses just above the high of that session and just below the low. They think they're safe. They are basically painting a giant bullseye on their own liquidity, literally. The algorithm sees that massive cluster of stop losses. So, when the highly volatile New York session opens, the smart money pushes the price up aggressively to trigger those stop losses. That's the first step, the liquidity sweep, which looks exactly like a breakout to a beginner. Exactly. 18. Fair value gap, open wound concept. Once they have swept the liquidity, they immediately reverse the price violently in the true intended direction. And that is the second step, displacement. And where does the gap come in? Well, that displacement is so fast and so violent, it leaves behind a fair value gap, or FVG. Think of an FEG as an open wound in the market's order book. It requires 3 specific candles. Okay, walk me through the 3 candles. Sure, the first candle closes. The second candle is that massive, violent displacement, just a huge surge in price. Then the third candle opens, moves a bit, but its lowest point doesn't even come close to touching the highest point of the first candle, leaving a literal empty pocket of air right in the middle of the second candle. 19. SMC entry model, patience, execution. So the SMC trader just what sits out the initial chaos. They don't buy the breakout. Precisely. They let the market show its hand. Instead of panicking and buying the moment the New York session opens, a disciplined SMC trader just sits on their hands. They wait for gold to sweep the Asian session highs. Very patient, extremely patient. Once the sweep happens and gold reverses with that strong downward displacement, they look for the open wound. They calmly place a limit order inside the fair value gap. They let the price naturally return to heal that wound, and they enter safely. 20. Slippage, the hidden danger. Wow. Right? The chaos is entirely mitigated by the framework. You aren't guessing. You are reading the footprints. That is a beautiful blueprint. It really is a very compelling argument. But have you considered the reality of human physiology under severe financial threat? What do you mean? Executing a flawless fair value gap strategy requires an almost robotic level of emotional detachment. It's practically impossible to execute if your hands are shaking, your heart is pounding, and cortisol is flooding your prefrontal cortex. 21. Position sizing, the real solution. I'm saying the crowd fails not because they lack the SMC blueprint, but because their risk exposure triggers their fight or flight response. You use the term open wound. Let's talk about what happens when you are the one bleeding. Let's talk about slippage. Okay, imagine you're in a crowded theater and the fire alarm goes off. That is a market gap. Okay, everyone rushes for the exact same exit door at the exact same millisecond. That's the liquidity drain. A stampede, exactly. Your technical stop loss is simply a polite piece of paper that says, "Excuse me, I would like to exit out this door at this specific price, please." But if 1,000 panicked people are crushing through that door, your piece of paper means absolutely nothing. 22. Risk management, survival mindset. That is slippage. Slippage is a very real structural risk. When the express train skips the station, your order gets filled at the next available price, which, can be far worse than you planned. It's the ultimate nightmare for a trader. And this is why the true ultimate cure for the fear of loss is not a technical concept at all. It is position sizing, just risking less money. Exactly. 23. Final conclusion. Technical versus psychology. So to summarize where we stand, we both definitely recognize that price gaps in highly volatile assets like gold are the ultimate crucible for a trader. From my perspective, controlling trading psychology requires demystifying the market, right? The structural approach, yes. By understanding the underlying mechanics, like distinguishing between the false security of a common gap and the massive momentum of a runaway gap, and by utilizing smart money logic to wait for liquidity sweeps and fair value gaps, you turn chaos into order. 24. Final reflection. Self-realization. And to summarize my stance, I believe structural knowledge will always be secondary to emotional regulation. A market gap is the physical manifestation of human panic and institutional maneuvering. The biological event, exactly. To survive those gaps, one must conquer FOMO, mitigate our deep biological loss aversion, and resist the herd mentality that creates the liquidity trap. 25. Final question for the viewer. I think where we absolutely converge is the idea that price gaps offer a really profound window into both institutional mechanics and human fallibility. A gap tells a story of an imbalance, a moment where the market simply could not find equilibrium between the algorithm and the crowd. It's the ultimate truth teller on a chart. 26. Closing thought. We leave it to you to decide which perspective holds the key to mastering your own fear of loss. Thank you for joining us on The Debate.